Good morning, everybody. I hope the week is treating you extremely well. Hope you guys had a fantastic holiday season. There's a lot going on here. We've had quite a bunch of volatility here over the last couple of months. And today's video, I want to look at both the bull case and the bear case as we head into 2019. There's a couple of things working for both camps. And we'll discuss some very important levels to pay attention to on the S&P 500 and what we can expect moving forward. Now, the blue moving average, the 50-month moving average, has acted as support now since 2011. When we had our sell-off back in 2015, you can see that's where the market made its bounce. When we had our sell-off last year, you can see it held at the end of the year right at that 50-month moving average. I think it's a very important line in the sand, not just because it's a monthly moving average, but also when you think about last year, the low of the year. If that holds, that would be a very good thing for the bulls, and if that breaks, that would be a very good thing for the bears. So that's the level that we're going to pay really, really close attention to. When we look at this chart, we see that the bulls are able to hold on to that 50 RSI zone. But on the negative, the MACD on a monthly has crossed over. The histogram has flipped negative. So if we're thinking about this in a positive light for the bulls, this zone acts as support. All right, we've got back up over those RSI levels. You know, we'll chop around for a little bit. We'll head back higher. The histogram will turn back positive, and everything will, continue to head higher. When we think about this from the negative side of things, when we look at real corrections that we have had over the last 20 years, they all bottomed out from RSI sub 30 zone. So if we're going to enter another correction like we had earlier in the last 20 years, all right, there's a lot of room for this still to fall, i.e. there's a lot of room for price to fall before we ultimately would see that bottom get put in, so to speak, right? Now, there's a lot of things that have to happen before we can really start talking about having a correction like we had in the beginning of the 20-year period and then back in 2007, 2008. We're not there yet, right? If we look at, I'm going to remove the 50-month moving average on there to keep this as simple as possible. The 10 and the 20. The 10 is the white moving average. The 20 moving average is the yellow. When these moving averages cross over each other and are declining, that has been a very negative sign of the last 20 years. It happened here, and it happened here, where we had our white moving average cross under the yellow moving average, and both of them were declining. That happened. We had another 2 years of selling there. We had another really bad, basically 6 months, 8 months, 2007, 2008. Well, here we are right here. All right, we have not had that crossover yet. All right, we did get it. If you were paying attention back in 2015, we got a crossover here as well. But the yellow moving average was not declining. The 20 moving average was not declining. The only two times in the last 20 years where those two have crossed over and are both pointed downward was here and here. You can see this as a potential for what could happen over the next couple of months. If prices do not recover, the 10-month moving average is declining. The 20-month moving average would subsequently start to decline, and you could see within 3 or 4 month period that we would get that same crossover like we had back in here and back in here. Hasn't happened yet, and we can't say that it's going to happen because it may not. But that is one thing we're paying very close attention to because that has been a very clear indication that we are going to continue to get lower prices. So pay close attention to that. We're going to be watching that. If that does continue to develop, of course, we will talk about that in these videos. Now, let's zoom in a little bit here, and let's look at this on a daily chart. And let's not look at current price. Let's look at previous price. Let's go back to 2015, and let's talk about the bottoming that the market made then and how that kind of relates to what we have right now. Well, what we have our sharp, hard sell-off on the first one. 3-4 sessions, boom, just fall from the sky, sharp bounce, plays out over the course of about a month, a test of those lows, and if you notice, we put in a higher low. So this low was lower than this low. So we had our higher low, and that ultimately gave us our nice W bounce. Ran into the previous resistance, time moves on, couldn't make a new high, rolls over, this time in a much longer downtrend, but once again makes the bounce, puts in a higher low, and makes a bounce. So 2 W bottoms with this set undercutting the previous set. All right, that's what we had back in 2015, 2016. Let's fast forward to this previous year, 2018. Real quick, sharp sell-off to begin with. We got a little over a month bounce, right? And then we got our rollover. We put in a higher low. Low, higher low. This ultimately holds. We grind higher here over the next 8 months, right? Run into resistance, push a little bit above it, can't really go anywhere. Then we have our sell-off. And this we tried to make a W bottom on as well, if you can see this right here. So here's our W, but we failed at this resistance, and then we rolled over. This low undercuts this low, just like we had before. And we've made our bounce at this point in time. So the question is what happens? If it plays out like it did back in 2015, 2016, it's something we have seen a lot in the past. We would be looking for that potential W bottom once again, if this zone right here is going to hold. What we'd be looking for is we'd be looking for a slightly higher low put in somewhere over the next couple of weeks. That would give us the best risk reward, and it would be very technically equivalent to what we have seen in the past. Does that mean this is what's going to happen? No, it's just a particular way that we can see things play out. Now, let's look at this in another light. Okay? We did a lot of technical damage last year. This right here is our major support / resistance zone. This whole zone that's right here. All right. We got our sell-off. That's where we made our bounce, right? We got another sell-off. That's where we made our bounce. We got another sell-off. That's where we made our bounce, right? Over here, we held this, right? We held it again. We tried to hold it a third time. Then we rolled over. And now what are we doing? We're testing this from the underside. What acted as support before could very easily act as resistance at this point in time. This is very sharp, very firm resistance right here, this 2600 level. If we add our 50 moving average on here as well, we can see that the 50-day moving average is going to sit right at the top of this resistance zone. We move forward a couple of sessions, it would be right there. All right, so we've had this wonderful bounce here over the last couple of weeks right into major technical resistance zone. All right, let's think about what a trend actually is. A trend is a set of higher highs and higher lows. That's an uptrend. Or a downtrend, a set of lower lows and lower highs. Right, so if we go back earlier this year, this is an example of an uptrend. Here's a low, here's a high, higher low, higher high. Higher low, higher high. Right? We have an uptrend. Price is moving up. Very clear, very clean, concise. Now, we look at what we have over here. We have a very clear downtrend. We have a low. All right, so we have a high, a lower high, a lower high. All right? We have a low, a lower low, a lower low, a lower low. All right? So we have lower highs, lower lows. That is a trend down. Now, how do we break a downtrend? All right, we have to take out the previous lower high, which is right here. Right? Another way that we could do it without taking this out would be to dip, put in now a higher low here, and then take out this high, and that would technically give us a smaller uptrend as well. But to negate this downtrend that we have had in place that's right here, we need to take this high out. So the bulls have a lot of work that they need to do here. Now, there's two major important levels. We laid out that resistance zone basically from here to 2640, that 50-day moving average. If the bulls can get it up over this level, that opens the door to make a move back to 2820. All right, because then we basically are back inside this trading range that we spent a month in. So if the bulls can get over that 26.40, they have a shot then at that 28.20. If they get over 28.20, they have negated the downtrend that was put in place over the last couple of months. So that's what we're really going to be paying attention to, right? Over the next couple of weeks, this zone that is right here is extremely important, all right? If we can't break above this zone, if the bulls can't break above this zone, expect to see that pull back down and that double bottom test. If we lose this, last year's low of the year, that would be that 50-month moving average. It would lose that double bottom. That would be extremely negative, and we would continue to see probably lower prices. So the two zones, for the time being, that are extremely important, last year's low of the year zone and the current zone that we're in. If we get over that, our next zone is this. And you can see how the market works. The market trades in essentially zones, in blocks of price action. And so we're in this bottom block. If we get back into this top block, that puts this up. If we get over that, then that puts the block towards all-time highs. So 1, 2, 3. Those are the levels that we're going to be paying attention to. As we move forward, we will continue to dive into these charts, talk about these different levels throughout the course of this year, and look at some other opportunities that we may have in other markets. I did want to real briefly touch on the emerging markets here. I want to look at this. This is a chart that I have not updated the drawings that are on this from the last time that we did this video. Major level of support here. We made our bounce. Remember last year we had our false breakout. 2 days and then immediately back under it. This year, we've made that bounce and we have actually broken that downtrend line again. So we have show you real quickly, we have another move above this downtrend line in the emerging markets. One other thing the emerging markets did, they did not put in a lower low in December of last year. They put in a higher low. The emerging markets could be in the process of bottoming, and this could actually be a legitimate breakout this time. I really want to see this index get back up over 1,000 and close there for a couple of sessions. But that would be a very good sign for the bulls. All right? If the emerging markets have actually put a bottom in, they really started that sell-off from the beginning of last year and was leading to the downside. If they start to lead to the upside, that's a risk-on marketplace. People investing outside of the U.S. into riskier markets means that people are willing to take on more risk, and that's typically a bullish sign globally. So what goes on in the emerging markets here is also very, very important. I think it will play a role in ultimately determining where we head for the rest of this year. I hope you guys found this video informative. It was a bit longer than normal, but there was a lot that we had to cover here. So I hope you guys have yourselves a fantastic 2019. Please like, share the video,